Welcome to the Cardinal Commentary for the Canadian equity portfolios. The Bank of Canada cut its overnight rate in June by 25 basis points, the first cut in more than 4 years, and followed that up in July by dropping it another 25 basis points to 4.5%, a level not seen for more than a year. Bank of Canada Governor Tiff Macklem says as inflation continues to moderate, it's reasonable to expect that more cuts are on the horizon. In fact, we believe we're at the start of a worldwide rate-cutting cycle that could last for the next year or more. The big question, of course, is when the Federal Reserve in the U.S. will join the party. After year-over-year inflation in the U.S. fell to 3% in June, Fed Chairman Jerome Powell is becoming increasingly convinced that inflation is returning to normal. Prices actually fell from May to June, which could pave the way towards an interest rate cut, possibly as early as late July or September. Two of the companies from the Canadian portfolios have been making headlines this year: Gildan Activewear and TDBank. Let's start with the Gildan soap opera. Last December, Glen Chamandy was ousted as president and CEO amid accusations he was no longer fit to lead the firm. A new CEO, Vince Tyra, and a new board were installed, and a 5-month-long battle ensued. Cardinal and other activist investors weighed in with support for Chamandy. In May, he was reinstated, and now things are finally returning to normal. Here's President and Chief Investment Officer Evan Manser during an interview on BNN Bloomberg.
I think this is the first time that I've talked about Gildan where there hasn't been huge controversy, so it's kind of nice. It's a bit of a relief. I think for Glen, we have spoken with him, and I think he's probably pretty reinvigorated right now, very excited to come back. You know, Gildan was already a good company doing well, while they obviously had this misalignment with the board. I think we've got past that now. They put out a plan. Browning West put out the plan, but it was with endorsement from Glen, and everyone's on the same page. The management, the CEO, the board, the shareholders. I think they're excited and energetic. I think they've got something to prove. And I think it's a great plan. So we're still sticking around with Gildan, and we think there's lots of upside from here.
We've sold TDBank. One of Canada's big 5 banks is under investigation for poor anti-money laundering controls in its U.S. operations that did not detect or report criminal activity. Despite being a solid performer for more than 30 years in Cardinal portfolios, the uncertainty of the size and severity of the penalties to be imposed, analysts believe they'll be in the billions of dollars, convinced us to sell TD.
But it's a bit of a warning sign for us that there are some major issues here. And then we look at the broader market and we do see some attractive opportunities elsewhere that don't have this risk. And so, you know, with heavy heart, we let go of our TD investment of 30 years.
6 of our companies increased their dividends in the second quarter, led by Sun Life Financial and National Bank at 3.8%, followed by TELUS, Pembina Pipeline, RBC, and BMO. The S&P TSX was slightly negative in the second quarter, but it was still the second best performing index in the world after the US. More importantly, our Canadian portfolios continue to outperform when it really matters, like over 25 years. And here's the proof. If you had invested $500,000 in the Cardinal Canadian equity portfolios in 1993, it would be worth more than $10.3 million today, far outstripping the benchmark. And why do we do all this? Because it works. And that's the update for the Cardinal Canadian equity portfolios. Thanks for joining us.